Welcome to Solidarity Spotlight, the place where we share with you bleeding edge stories. I'm your host, Solidarity. Let's discover what's happening today in blockchain. The cryptocurrency landscape continues to evolve at breakneck speed, with today bringing a fascinating mix of market movements, technological breakthroughs, and institutional developments that paint a complex picture of where digital assets are headed. The global cryptocurrency market cap now stands at $3.85 trillion, representing a 0.72% increase over the past day. Though beneath this seemingly stable surface lies a world of rapid change and emerging opportunities that could reshape the entire sector. Bitcoin finds itself at a particularly intriguing crossroads, trading at $110,699 and down 1.35% for the day, yet simultaneously generating intense speculation about its trajectory toward $150,000 in 2025. This ambitious price target isn't merely wishful thinking from retail investors, but is grounded in sophisticated analysis of halving cycle fractals and institutional adoption patterns. Analysts citing these cyclical patterns are setting their sights on a $150,000 peak by October, with some even envisioning Bitcoin moving north of $150,000 by year's end, potentially reaching as high as $200,000 given steady ETF inflows and institutional demand. The mathematics are compelling. At current levels near $114,000, reaching $150,000 would represent an upside of nearly 36%, a significant but achievable milestone considering Bitcoin's historical performance following halving events. However, the institutional Bitcoin ETF landscape tells a more nuanced story. Recent data reveals $160.1 million in net outflows on September 5, 2025, with major players like BlackRock's iBit experiencing outflows of $63.2 million, while Grayscale's GBTC saw $47.3 million pulled out, and Bitwise's BitIB recorded $49.6 million in redemptions. This selective pullback, rather than widespread exodus, suggests institutional investors are becoming more discriminating in their approach, possibly reallocating capital based on fee structures and product performance rather than abandoning Bitcoin entirely. The market impact of these flows cannot be understated, as institutional demand has been absorbing Bitcoin 4 times faster than new supply is mined, creating structural supply shortages that historically precede sharp price rallies. Ethereum presents perhaps the most dynamic story in today's blockchain ecosystem, holding steady above $4,300 amid growing institutional demand and exchange outflows that have reached their lowest point since 2021. The second largest cryptocurrency by market cap is trading at $4,293.16, down 1.95%. But this modest decline masks significant underlying strength. Ethereum's liquidity tightening due to steady outflows from exchanges, combined with significant inflows from Ethereum-focused ETFs, creates a compelling supply-demand dynamic. BlackRock's iShares ETF alone oversees over $16 billion in assets, representing clear institutional confidence in Ethereum's future utility and value proposition. The Ethereum staking environment continues showing remarkable growth, with over 35.6 million ETH now staked, representing almost 30% of the circulating supply. This surge in staking reflects growing institutional participation in Ethereum as a yield-bearing asset, with current staking rewards averaging 2.9% APR, attracting waves of institutional investors. Its development positions Ethereum not merely as a speculative asset, but as a reliable yield-producing instrument that could serve as a cornerstone of institutional digital asset portfolios. The burn mechanism introduced through EIP 1559 has led to the destruction of 1.99 million Ether tokens, worth $8.8 million, consistently pulling Ether from supply and contributing to value appreciation for remaining tokens in circulation. Solana emerges as perhaps the most impressive technical performer in today's blockchain narrative, processing an astounding 2.9 billion transactions in August, marking a 46% year-over-year increase and exceeding the combined transaction volumes of all other major blockchain networks by more than 4 times. This surge in activity underscores Solana's growing adoption and efficiency in handling high-throughput transactions at relatively low costs compared to other platforms. The network generated over $148 million in decentralized application revenue in August alone, with approximately $85 million attributed to decentralized exchange trading, highlighting Solana's role as a major hub for decentralized finance. Solana's total value locked grew from $8.5 billion to $9.5 billion within the month, extending into September with further growth to $11.51 billion. This expansion was complemented by significant increases in stablecoin liquidity, which reached over $12.26 billion. The chain's capacity to attract and retain capital in its DeFi protocols demonstrates its performance and scalability advantages. Solana's native token, SOL, experienced bullish momentum during the same period, rising from around $163 to peaks above $215, accompanied by a 30% increase in open interest for SOL derivatives, which remained above $6 billion. Notably, the majority of these derivative settlements occurred on-chain rather than through centralized exchanges, reflecting growing confidence in the Solana ecosystem's infrastructure for handling complex financial instruments. The network's expansion into real-world asset tokenization represents another significant development, with over $500 million in value being tokenized, primarily in equity form. This advancement positions Solana as a leading platform for bridging traditional finance with decentralized finance, potentially capturing significant market share as institutional adoption of tokenized assets accelerates. Market projections suggesting Solana could reach $300 in September appear increasingly plausible given this combination of technical performance, institutional interest, and expanding use cases. The decentralized finance sector experienced both triumph and turmoil, highlighted by an unprecedented event at Venus Protocol that could reshape how the industry approaches security and governance. Venus Protocol successfully recovered $13.5 million stolen by North Korea's infamous Lazarus Group hackers through an emergency governance vote, marking the first time a major DeFi hack's proceeds were fully clawed back. The incident began when a high-value Venus user was compromised through a phishing attack involving tainted Zoom software, allowing the Lazarus Group to drain liquidity by borrowing against the user's collateral. What followed was groundbreaking for the DeFi space. Venus's community and development team mounted a coordinated response, with security firms Hexagate and Hypernative raising alarms within minutes of the attack. The protocol implemented emergency brakes to halt further losses while developers confirmed the platform itself wasn't breached. In an expedited on-chain governance vote, Venus token holders approved forcibly liquidating the attackers' positions and freezing the stolen assets, enabling the protocol to seize back the cryptocurrency and transfer it to a secure recovery wallet. Within 12 hours of the hack, the stolen funds were largely back under Venus's control. An unprecedented turnaround for DeFi that showcases both the potential and contentious trade-offs of decentralized governance in emergencies. This development could have profound market implications, as it demonstrates that DeFi protocols can act decisively to mitigate losses, potentially outperforming traditional centralized finance systems that might take weeks to unwind a breach. However, critics argue that such interventions edge into centralized territory and blur the code is law ethos that underpins decentralized finance. A successful recovery could encourage more institutional participation in DeFi by reducing perceived security risks, while simultaneously raising questions about the true decentralization of governance systems. The broader cryptocurrency market reflects a complex interplay of regulatory developments, technological innovations, and institutional adoption patterns. August employment data sparked initial crypto rallies as traders interpreted stagnant figures as signals for potential Federal Reserve monetary easing, pushing Bitcoin above $113,000 and lifting altcoins across the board. However, subsequent market movements demonstrated the continued correlation between cryptocurrency prices and traditional financial market sentiment, with risk-off conditions quickly reversing initial gains. Emerging altcoin opportunities continue capturing investor attention, with projects like Remitix presenting compelling narratives around real-world utility and aggressive return potential. Having sold over 645 million tokens at 10 cents and raising more than $23.9 million in funding, Remitix secured listings on Bitmart after surpassing $20 million, and later on L-Bank once it passed $22 million. With additional centralized exchange listings on the horizon, the project's focus on enabling cryptocurrency to be sent directly to bank accounts in over 30 countries, combined with deflationary tokenomics and CertiK auditing, represents the type of utility-focused development that could drive the next wave of cryptocurrency adoption. Real-world asset tokenization continues gaining momentum as one of the most significant trends reshaping the blockchain landscape. The tokenized real estate market is projected to reach $19.4 billion by 2033, with platforms enabling fractional ownership through blockchain-based digital tokens. This development offers lower entry costs, global access, faster transactions, and improved liquidity compared to traditional real estate investments. The broader asset tokenization market is tracking toward $2.08 trillion by 2025, with projections suggesting growth to $13.55 trillion by 2030 at an annual rate of 45.46%. Institutional adoption patterns suggest growing sophistication in digital asset allocation strategies. By 2027, institutional investors might allocate between 7% and 9% of their portfolios to tokenized assets, while 12% of real estate firms globally have implemented tokenization solutions, and 46% are actively testing pilot programs. Major deals highlight this trend, including T. Rise Group's $300 million agreement to tokenize Project Chamflery, a 960-unit residential development in Canada, and Kin Capital's plans to launch a $100 million real estate debt fund targeting institutional investors. The regulatory landscape continues evolving with significant implications for market development. The SEC and CFTC have presented a united front regarding future regulatory moves, with agency chiefs stating that crypto turf wars are over as they move ahead on joint work. This coordination could provide the regulatory clarity that institutional investors have been seeking, potentially unlocking additional capital flows into digital assets. The emergence of new legislation in the Senate Banking Committee for crypto market structure bills that would establish U.S. regulations for crypto trading represents another step toward comprehensive regulatory frameworks. Web3 gaming and blockchain-based applications continue demonstrating significant growth potential, with the evolution of blockchain-based leaderboards redefining competitive play, asset ownership, and economic incentives. These systems offer transparency, security, and programmable rewards that align with core Web3 principles, creating ecosystems where engagement and monetization are inherently aligned. The Web3 gaming market's projected 30% compound annual growth rate highlights substantial investment opportunities, though challenges like onboarding barriers and token volatility require scalable solutions for mainstream adoption. Cross-chain interoperability and artificial intelligence integration represent emerging trends that could catalyze explosive growth in the cryptocurrency space. The convergence of AI and blockchain is creating new market sectors, enhancing automated trading and decentralized applications, while Layer 2 solutions continue addressing scalability issues crucial for long-term adoption. These technological developments, combined with growing institutional interest and regulatory clarity, create conditions for significant market expansion. Looking ahead, September 2025 presents an exceptionally dense calendar of market-moving events, featuring $4.5 billion in token unlocks, coordinated SEC-CFTC regulatory clarity, Federal Reserve policy decisions, and major protocol upgrades. This combination of the largest token unlock wave of 2025 with bullish regulatory developments and potential rate cuts creates significant volatility potential across all market segments. The month combines technical upgrades, macro policy shifts, and unprecedented token supply pressure, creating conditions for significant volatility and potential trend reversals. Market participants should prepare for heightened volatility as these multiple factors converge. The interplay between institutional ETF flows, regulatory developments, technological upgrades, and macroeconomic policy changes creates a complex environment where traditional correlation patterns may break down. Projects demonstrating real-world utility, strong tokenomics, and institutional adoption are likely to outperform those relying solely on speculative momentum. The cryptocurrency ecosystem's maturation is evident in the sophistication of both institutional participation and technological development. From Bitcoin's evolution as a store of value and potential $150,000 price targets, to Ethereum's transformation into a yield-bearing institutional asset, from Solana's technical achievements in transaction processing to DeFi's innovative approaches to security and governance, the blockchain space continues demonstrating its potential to reshape global finance. The successful recovery of funds from the Venus Protocol hack, the growth of real-world asset tokenization, and the emergence of Web3 gaming and AI integration all point toward a future where blockchain technology becomes increasingly integrated with traditional economic systems. That concludes today's Blockchain Spotlight. I would love to know your thoughts. Thanks for listening, and don't forget to follow me for more spotlights. See you next time.